Okay, very good morning. Tuesday the 14th of March. Let's get the briefing underway and discuss a few points that have come out, notably in regard to the Brexit bill last night. As looking at the charts this morning, despite the moderately positive close that we had on Wall Street, it's pretty flat in the SPOOs, but up just shy of 0.2 in the Nasdaq and 0.1. Actually, it was lower in the Dow. It's a bit of a mixed closed. That kind of translates to a mixed Asian session, but as soon as Europe's come in this morning, you can see here in the center and the top line of my charts, cable has come under some concerted selling pressure, moving from pivot all the way down to S2. That's then sparked, I guess, a degree of risk-off sentiment, albeit fairly mild at this point, but equities on the back foot. A little bit of a move lower out of that fairly tight range in the S&P overnight, back below pivot to S1, with the DAX under some pressure with half an hour into the cash equity session. Fixed income, pretty quiet thus far, but gold as well, with some of the move lower in equities and the risk-averse sentiment just edging up, albeit slowly, just off that 1200 handle, which lines up today with that S1 on the daily pivots. So without further ado, then really you've got to focus on the pound. That seems to be the kind of lead product this morning. And just taking a look at the move, and it's quite interesting because this was something that I've talked about with some of the newer guys before, and this is about the timings of the various different products that you trade and how, generally speaking, in the FX markets, it tends to be you've got to get up pretty early in order to capture that initial move, which is kind of the mainland Europe come in, and then UK participants come in slightly after, and that's when you tend to see a bit of a pickup in the order flow and then the corresponding movement in the market. Now, if I put this back on the 5-minute chart, probably make a little bit more sense of what I'm talking about, because just because I'm a bit sad, I was on Twitter awaiting the announcement from the House of Lords last night, and it came pretty much just after 10 p.m, that news that both those amendments got voted down. Therefore, it's been passed, and the ability now for the government has gone through to trigger Article 50, and we'll look at that shortly. But as you can see in the overnight session, really very little reaction, if any. We had a slight move lower over that hour, really, where the announcement was, but really this is pretty slow movement over an hour. It's probably about the size of about 25-30 pips, but then in Asia overnight, absolutely nothing. Just very narrow around pivot. And then you can see 6 a.m. pretty much to the minute. It's almost as if Europe switches the machines on, and then bang, the selling pressure happens. You get a pickup in volume, and then we immediately dropped about 40 pips right down to the S1, which was around the 122 handle. That then provided a bit of resistance after that initial break, and then really when the rest of UK gets underway, going into 7 o'clock, it then gets hit again, and then when kind of, if you like, the retail traders come in, and then you have that last final little dip. You can kind of see there the news dissemination over the different time frames, because obviously mainland Europe an hour ahead, you get the initial interpretation and move. Then you get another move ahead of 7 down to where we are at the moment. No movement seen overnight in Asia, though. The move this morning, I think, if I look a bit more longer dated, this is when we're looking at the June future here, so it gets a little bit thin when we start going back in toward the end of 2016, but really kind of mapping out, I guess, year to date. That level, which we've already broken this morning, however, it's kind of pulled back to it at the moment. At 121.61 was the low we printed back on the 9th, so towards the end of last week. That probably helped accentuate some of the initial run lower before this bounce that we've seen. But below here, we're looking at the 121 handle now. That matches up with the Jan 11th low, and then the year-to-date low would come in down at this 120.35. That's kind of your downside targets, I guess. The bigger psychological kind of barrier to the downside, I would say, is really that 120 handle. That would be quite a big signal or bearish signal to the market if we were to move below that point, because obviously it would also be fresh lows on the year. Arguably, with the Fed possibly leaning on the side of a more hawkish hike, so potential for dollar strength in the backdrop now of some re-weakening and negative sentiment occurring in the pound, overlaying this as well with those calls for a second Scottish referendum seems to be getting further airplay this morning as behind some of the reason for the increased nervousness as well. So let's have a quick look at the main headline then. This was UK Parliament giving Theresa May permission to start Brexit. A couple of points to look at then. Preparing to trigger Brexit in the last week of March after securing the permission of lawmakers to begin 2 years of talks with the European Union. This is what I was talking about yesterday in regards to the fact that this kind of politically termed ping pong, which is where it goes back to the House of Lords, wanted these amendments, it goes back to the Commons have said no, therefore the Lords accept that defeat. They don't go back and forth, and hence the passage that you've seen. In terms of those lawmakers rejecting the two revisions, that was by unelected peers that would have guaranteed rights for EU citizens living in the UK. So Vas, if you need a hug later, you can come over to the desk. Can make you feel better. Otherwise, the other thing as well that we were looking at was the one about having a meaningful vote on the Parliament having a say on the final kind of Brexit deals, and that also got voted out. And so now it comes down to people are looking and talking about this morning, when is it when Article 50 will eventually be triggered? And really you can make a pretty strong educated guess as to when this will be, given events that are already scheduled. And if you're waiting until the end of the month, that seems to have been the signal. Last week we were kind of looking at potentially today could have been the day, because Theresa May is due to be giving an update in the Commons about her meetings at an EU summit that took place last week. Definitely we'll be tuning into that later. But much of her team surrounding her have been saying towards the end of the month without any explicit date. But timings wise, March 25th, celebrations in Rome of the 60th anniversary of the EU's founding treaty, so very unlikely that she's going to do it over that event. That'd be almost like trying to think of a polite way of saying it, but if you're going into these negotiations, you wouldn't want to be triggering on a day of European celebration, otherwise that's kind of salt in the wound, so to speak. Also, you've got the Dutch election, of course that's happening tomorrow, results of which we'll see Thursday morning. You've got the Scottish National Party's conference on March 17th, 18th. March 26th is a Sunday, and British Parliament recess begins on March 31st. So very much here, the likeliest days of the notification are between March 27th and March 30th. And that's what officials have also hinted. So if you're looking for timings of when this is going to be formally triggered, it's going to happen between 27th and March 30th. Just so happens to be coinciding with my birthday as well. So actually my birthday's the 26th, so she's quite politely evaded that. But looking at a timeline, this is from Danske Bank, and this is where we are at the moment then. All analysts are looking at a very similar thing in terms of UK is most likely to trigger Article 50 in that period. That's the most logical point. Now, what I've been saying in recent briefings is that I'm a little bit surprised actually by the market move this morning. The fact that it's gone through, I think, is very unsurprising. This just means that it's going to happen. We always knew that. I didn't think that the House of Lords amendments would actually ever come to anything. But maybe this Scottish referendum thing about their kind of quest for a second referendum, whether that would be autumn 2018 or into 2019, but within that 2-year negotiating period, has prompted a bit of nervousness and additional pressure on the government going into these first negotiations. But again, I think that's a little bit far-reaching to blame it on that, because ultimately I think the landscape on Britain and its sentiment and feeling towards Brexit is going to be starkly different by autumn of 2018, 2019 than what it is at the moment. And so whether or not that Scottish referendum would even still apply in the context at the time, I think maybe not. Things more here and now, though, to look out for, and this is really how to trade sterling, I think, going forward. Obviously, we just look technically. There's a couple of interesting levels as we get down to year-to-date lows, and that 120 psychologically would be a big marker on the downside should we move through there. But really, it's the first couple of Eurogroup type meetings that happen and summits post the actual triggering. Now, the triggering needs to take place before the end of the month. We know that. So let's just assume that does happen. Then you've got a Eurogroup meeting on the 7th of April. And then you've also got an extraordinary EU summit on Brexit, specifically after the 6th of April. Now, these, I think, will be really critical to get the initial kind of tone, because the market really doesn't have much of a reference point at this point in time. I think that will serve as a good benchmark to the type of language that Europe will have as a collective, because at the moment we've heard of some of the more peripheral type nations which have been quite aggressive, saying we're not going to do a deal with Britain unless it's on our terms. But when we hear from the likes of Angela Merkel, from France, from Italy, these are things that will then define the shape of initial discussions. And I think that's when you'll get a bulk of volatility, certainly for the sterling currency. So, for those cable traders, I think, there's going to be more volatile times ahead. And as such, some more larger price swings might offer some opportunities going forward. This, of course, then leads us into one of the main political events after, of course, the Dutch elections this week, and that being the first round of the French elections on the 23rd, and then we'll get the second round from France on the 7th of May. So quite a good timeline here from Danske Bank to what to look out for. Talking of politics, update then for the Netherlands, where we've had a televised debate last night, where PM Rutte and Velders swapped jibes in debate. 36 hours then till the Dutch actual vote. I would say there was nothing really too much surprising that came out. The current Prime Minister Mark Rutte and Populist Freedom Party leader Velders questioned each other's credibility and integrity. They faced off in a live debate. The Liberal Premier said he would not trust Velders again after the Freedom Party walked away from supporting Rutte's first minority cabinet in 2012. And basically was suggesting then that he would not look to form a coalition with the Freedom Party. This then just kind of increases the likelihood of this stalemate, even whichever way really this election goes. Hence the reason why I think that overall, although you might get a knee-jerk response in the markets if Geert Wilders wins, which would be probably a net negative response in the euro currency, I don't think you're going to get an all-out assault, if you like, in the market fear, given the fact that in reality there's a lot of complexity in towards the forming of a multi-grand coalition of several parties, maybe possibly as much as 5 or 6 different parties. So that will contain maybe some of the fallout. From France, obviously this is going a little bit, this is what I mean by when there's all these different macro themes going on at the same time. They tend to take kind of order of priority, and I guess on the timings of things with the Netherlands going to the polling booth tomorrow, it means that France has dropped off the kind of number one spot on the political front. But an interesting development from yesterday or last night, that's the former French Prime Minister Valls will ask voters to back centrist candidate Emmanuel Macron in the first round of the April-May presidential election, according to Le Parisien newspaper, citing sources close to the former PM. Now this is interesting because Valls, this chap here you're looking at, is throwing his support behind Macron, is a blow to the ruling Socialist Party candidate Benoît Hamon, who Valls lost to in the January nomination of the primaries of that party. So basically what Valls is saying then is that Benoît Hamon, you stand no chance, therefore I'm better off making sure Le Pen doesn't win, and so let's just get our voters to back Macron by a larger degree. And so if you remember how the market and polls responded to the various centric alliances that you had with François Bayrou, some other former politicians, some other parties also giving him backing now, is likely to just further cement the market expectation that it is increasingly difficult to see a Le Pen victory here, albeit not to be discounted. So that's your update with France. Looking elsewhere, a few things just so you're aware. We've had some Chinese data overnight, but again, when you're looking and assessing on an intraday basis what the macro drivers are, then really when I look at things like the Chinese data overnight, I do pay attention to it, I do read about it, I'd like to know what's going on, but ultimately it's not a defining part of what's moving the financial markets right here and now. It's more kind of simmering in the background. And what you've had, a couple of data points of significance though: industrial production, the bottom line, the bottom line, the top line, retail sales, which is weakened, so it was a little bit softer than expected, but fixed asset investment is up year to date. So a bit of a mixed picture, industrial production wise then picking up, but consumer side, the retail sales has softened. One quite interesting point in China's fixed asset investment, now this is broken down really in regards to state and private. Overall it's been fairly consistent, and any of this decline that had been seen over previous years seemingly has started to steady out, as what we've seen with Chinese GDP has started to see a small incline in its more recent readings. Then likewise fixed asset investment also ticking higher, and that's quite a good sign as well, this graphic says to me, because you're moving away from the state having to step in with large scale kind of stimulus, and the private sector is starting to take some of the weight, which is a more confident signal, I'd say, in the economic performance and ongoing future for the Chinese economy. If you look at this divergence, then it kind of tells a picture or a story in my mind, because if you remember back to the beginning of 2016 when the market went into severe shock mode on the back of an extreme degree of volatility in China on fears of a hard landing, that's when state fixed asset investment ramped up in order to counter that fallout. Private investment fell sharply as confidence fell, and what you're seeing here now is the opposite of that, as confidence in the geographic area and performance of China starts to improve. Quick look elsewhere, some other things as well of note. And this is an article in Bloomberg, and one of the chaps here on the floor was asking me yesterday about the oil curve and about contango and backwardation, and a few people had been talking about that, so I wanted to just quickly talk about that for a few minutes as well for the benefit of everyone else. And really the chart here sums it up, and what you're looking at is to explain the situation, we have come out of a period, and we still are in that respect, of a global supply glut. That's an oversupply in the market. So when the price kept falling about a year ago, when the US or when OPEC kept pumping, irrespective of prices falling, in order to take out the shale industry by driving the price below their break-even point, although that did work to a certain degree at the time, it definitely underestimated the flexibility, as we've seen, for shale to return and be quite rampant like we're seeing right at this present time. But what it meant though, with OPEC not cutting at that time when the price was falling and demand globally was fragile on the back of things like the China slowdown and Brexit, what that essentially meant was that we've got a very oversupplied market. What OPEC have tried to do then is, by cutting productions, you want to eat away at those inventories in order to get back to a normal state, which would be normal backwardation, where what that would mean is that the current futures price is lower than the price in the future. So therefore prices are going to go up on the premise that inventories are going to fall, supply diminishes, but demand returns, if that makes sense. So the future price will be higher than the current. Now what you can see here is that obviously the OPEC made the agreement back on the 30th of November, and that was when they agreed that they would cut production for the first time in several years. What their intention is then is to start chipping away at this oversupplied market, so that then we can start to force the price higher as the ultimate objective, or at least keep it to a point where they're not being so pressured on the fiscal side of things. So since the beginning of the year, the market has become less and less in contango as those cuts and compliance levels have been fairly high, to a point where we actually went into backwardation for a very brief period. I guess this would have been, looking at the timelines here, late February and then going into March. The only problem is that people have now started to question or not whether or not this is enough. The US obviously have sharply started to turn on the taps and really get those rigs back online and start pumping. US output is increasing at a very sharp rate. And then also the market may be a little bit disbelieving that OPEC now are in a bit of a rock and a hard place and questioning whether or not they have the will to want to cut again when it comes in 6 months' time when the current deal expires. So as such, the market now in contango is starting to re-widen, so to speak, i.e. they actually see prices starting to fall in the future compared to where the current price is. So that's what this is telling you when we talk about these particular terms. And as what we were talking about, I think, here yesterday, we need to be looking out for any signs from OPEC that they will look to be taking action over, or already hinting towards it, when it comes to June when the current deal expires. That, in combination with monitoring, I think, the US output situation and the speed of its increase, are going to be very telling signs for how to gauge the direction of WTI crude oil for the time being. Looking at oil this morning, really not a hell of a lot of direction in yesterday's session. I would say a lot of that likely is quite typical of just market consolidation after such a big fall that we had. This is when we marked up that big move of in excess of 10% last week, and then the market went into consolidation mode, and very quiet schedule as well, and ahead of these big events forthcoming. That kind of makes sense to me. So maybe just keeping an eye on that top side of that near-term range at 48.68. I think then you've got the likes of R1 sitting above, and then a $49 handle on the intraday. Okay, quick look then at the calendar for today. So this morning, 10 o'clock, you do have the German ZEW Economic Sentiment Index. I would say after IFO, this is probably one of the more bellwether type numbers that you get out of Germany. Just a quick recap for those newer to the market. The ZEW Economic Sentiment Index measures the level of optimism that analysts have about current economic situation and expected developments for the next 6 months. So a couple of key points here. This is what you would call forward-looking, or more of a soft indicator, and it's the reason why it carries then some significance is we're trying to gauge European, German market analyst expectations of performance over the 6-month period. If you think about the next 6 months, there's a lot of political upheaval that we could potentially see, and so what are their thoughts going forward will be a telling sign. This is essentially then a survey of 350 experts from banks, insurance companies, financial departments of selected corporations. The difference between this and IFO being actual companies, if you like, this being experts and analysts to give their opinion. So it's slightly different in that respect. In terms of the actual data set, the previous reading, it did decline from 16.6 to 10.4, which was in fact then the lowest we've had since October. 10.4, I believe, as well, was below expectations at the time. So we'll be keeping an eye out on this number. It comes out at 10 o'clock. Otherwise, you have Eurozone industrial production coming out at the same time. I'd give that a much lower weighting in terms of market impact. ZEW is the focus. Then going into the afternoon, you start to get US PPI numbers are kind of the main headline reading. Don't forget the time change is still narrowed, will be for the next 2 weeks with the clock change in the US at the weekend. So your 1:30s are now 12:30, so don't be caught out by that. And then you've got the API inventory numbers, which come later on this evening. So not a massively busy calendar, but a couple of more things going on today than what was scheduled for yesterday. Really, the key day is tomorrow. You get US CPI, retail sales, and of course the Fed in the evening. So again, the market barring any shocks, might be a little bit contained, awaiting for those bigger things to occur. And then you also have to factor in things like the Dutch elections as well. Looking at the PPIs quickly for the US, that's been a fairly stable indicator, I would say. 1.6% both measures in the last 2 months. Really, it's the CPI which the market will be more interested in, which will be due for release tomorrow. And the final thing as well to keep in mind for today is Stella. And I don't mean the pint, I mean the blizzard that's coming in toward northeast coast of America. Now this is important because you've already probably read some of the headlines on the way into work this morning. Lots of flights have been cancelled for the imminent kind of storm watch, if you like, and that's going to impact the New York state area. As such then, what this typically means is that a lot of people can't make it into work, and trading volumes then are impacted, and you tend to get, on these days, fairly quiet markets. Or can potentially happen, you get some erratic price movement that can happen due to the kind of lack of liquidity that we'd normally see. So keep that in mind if it does get quiet, and given the fact that these other scheduled big fundamental events are still yet to come in the second half of the week, and then you've got the poor weather conditions set to really kick in today in New York City, it could lend its hand to a fairly subdued session overall. Okay, that's your morning briefing then, coming up to 9 o'clock. I'll leave it at that. Any questions though, please feel free to fire them in the chat. Happy to help. Okay guys, have a good session. Thank you.